Welcome everyone to our Business Builders series. My name is Faith Gunderson and I'm the marketing coordinator here at Shea Fritz & Dean.
Hi, and I'm Doug Dean. I'm owner and managing partner of Shea Fritz & Dean. One thing that I'm proud of at our firm is that we like to try to find ways to give back to the real estate agent community that we serve. One way we do that is we teach several CE classes each month, which we volunteer and donate our time for that. Another thing that we've started is our Business Builder Speaker Series. It's the third Wednesday each month at 1 p.m. And we find folks that can deliver valuable content to you as a real estate agent to help you in your business.
Again, we want to welcome you and we want to thank you for being here. We know you're busy, so we appreciate you giving us your time. To make the most of your time, we encourage you to ask questions and participate by utilizing the chat box. Before I introduce Stephen, I want to let you all know about next month's series, which we will have Steve Beecham. He is the president of Hometown Mortgage, and he will be presenting Have People Call You and Beg You to Sell Their Home. This will be June 16th at 1 p.m. Welcome, Stephen Lazarou, president of Zeus Consulting Services.
Steve is a CPA and will be teaching today on accounting and tax issues for the real estate agent. I'm going to stop sharing my screen and I'm going to make Steve the host so that he can share his screen.
I can share it now, Doug.
One more second. Make host. Yes, you should be able to share your screen now, Steve. Take it away.
So you all see that? I can't tell. Real estate investing, a good start to what you should know. Do you see that, though?
I do see that. Go ahead and start the slideshow view.
Hey, guys, I'm Steve Lazarou. I've been working with Doug and his partner, Richard, God rest his soul, for a bunch of years now. So they asked me to come in and give you some background. I've been a CPA. I've been in Atlanta 40 years. I went to Emory University. I've been a CPA since 1987. I started with KPMG in their audit department. And I've worked in various industries, banking, telephone, IT consulting, real estate. I even owned my own mortgage company for a few years. I started my CPA practice on my own in 2000. Where I just offer accounting services, consulting services, and tax services to my clients. I have clients all over the country that I help, but I have a lot of background in experience in real estate. I've been working in real estate for a while and had a mortgage company for 6 or 7 years, so I'm pretty familiar with the with how taxes impact real estate. So we'll get started. All right, here's a few topics I'm going to discuss today. We're going to start with residential real estate. And then after each, how does the chat box work, Doug? Do you want me to stop after each topic to talk about it? You want to wait to the end?
Yes, as I see people who either raise their hand using the reactions button or throw a question in the chat window, I'll throw it out for you.
Okay, so I'll stop after each topic because I'd rather just address the topic before we get to the end so it's easier for me. Okay, so these are the few things I'm going to touch base with today. Capital gains tax on your primary residence and the exemption that you get if it's a primary residence. So that's one of the topics we'll talk about. We'll talk about how you're limited on the deductibility of your taxes, and which includes your real estate property taxes on your primary and your secondary home. And then one of the things I notice my clients don't do a great job of is they sell their home and then they don't have any good record keeping on what the basis of their home is. So this is just a tip you can give to your clients and something that the record keeping that they should do. So when they sell their house, they know what the actual basis is so they can minimize their gain. And then we'll step into the investment side of real estate. We'll talk about depreciation and how it impacts an investment. We're going to talk about, the next topic will be passive versus active participation. That's really, for accountants, it's really important that, But there are, even though if you're passive, there's still some outlets for you to get some deductions. And then the last topic, which could go away, is 1031 exchanges. What's a 1031 exchange? That's one of the topics that Biden wants to do away with. So with his new tax laws, we might see that go away. But it's something I think you should know about just in case it sticks around. All right, let's get on to if you guys have your residence and you decide to sell it. One of the nice things the tax code allows is you can be exempt of capital gains up to $500,000 if you're married filing jointly, or $250,000 if you're single or head of household, or married filing separately. So what this means is, so you buy a house for say $1 million, and you sell it for 1.5, which is a $500,000 gain. If you live there the last 2 years and it's been your primary residence, that gain is exempt. And you can do that. So it must be your primary residence. One of the rules is you have to live there the last 5 years as a primary residence. And the other one good thing that changed in 1997 is that you used to have to take that money and reinvest in the new house. Now that's no longer the case. You can take that money and spend it any way you want. You don't have to invest in a new house. You can go put it in the stock market, whatever you want with it. So you're not forced to reinvest in a new house after you sell the house. All right, let's move on to the next screen. Okay, so there's some exceptions to this rule that you don't get those exemptions, and I'll go through them with you. One, if it's not your principal residence, you don't get this exemption. So if it's a secondary house or it's an investment property, this exemption doesn't apply. The second rule is if you acquired this house through a 1031 exchange in the last 5 years, you also don't get this exemption. Another rule is if you're subject to expatriate taxes, the exemption isn't there. And then we talked about previously, you didn't use it 2 of the last 5 years as your primary residence. Oh, and the last one is you're only allowed to do this every 2 years. So you can't claim this exemption. If you've done it in a 2-year period, you don't get to do it again. You have to wait after the 2-year period is expired. Anybody have any questions on these before we move to the next topic?
So I got a question.
Sure.
From what I was told, not so much with Georgia, but I know you're only supposed to claim homestead for your primary residence and one property. From what I was told, and I don't know if you know anything about this, in the state of Florida, if you live there, I think 4 months out of the year, they'll let you actually homestead there also, along with your primary residence.
Oh, really? I didn't know. I'm not aware of that. I'd have to look that up for you. I'm not sure on Florida. Florida wants people to move there. They don't have any personal income tax in Florida.
Right.
They make their money through tourism and sales tax. So the more
Yeah.
I'm licensed in Florida too, and that is the case for Florida.
That is the case?
Yeah, I'm licensed in Florida. I'm a broker there too, and it's
Okay.
the case.
Okay.
And then so that you're still allowed to have your exemption in Georgia, even if
you have a dual residency, yes. If you're there for more than 4 months, you can have it there, and then you can have a Georgia residence as well.
Okay. I'm not sure how that impacts your when you apply what state you're a resident for your income taxes. So that was something I would have to look into because I'm not 100% sure on that.
I just have a quick question too.
Sure.
We have a second home too, but we never rented it, and it was not an investment property. It was more for like to downsize. But by the time we get done with like fixing and everything, my kids didn't want to move there because it's in Rockmart. It's more like country. And of course, I'm in the primary residence that we have been living. We have a homestead on that one. So now I want to sell the other house in Rockmart. So what would that be as an, if it comes to taxes and, but we have it for more than 2.5 years.
Yeah, but it's not your you still have to pay capital gains on it because it hasn't been your primary residence for 2 of the last 5 years. So in order to do that, you would have to change your homestead to that property and have to be your primary residence for 2 years in order to get that exemption.
Okay, alrighty. So no, if we don't get, because we went there and we asked them, they said that we can have only on one, and we had, I mean, on this one because this is where we have been living.
So if you want to have the exemption apply, you'd have to file for your homestead on the second home and have it there for 2 years. And then if you waited 2 years, then you could get this this exemption because it's
Okay.
for the last 5 years. So if you live there for 2 years as your primary, if you have your homestead, it's considered to be your primary. And if you waited to then and sold it, then you'd be exempt from capital gains if you're married filing jointly up to $500,000.
Okay, already. Thank you.
Oh, you're welcome.
And otherwise, how much is the gain tax, I mean, on the?
Well, it's tiered. I'm not sure from the top. I think if your AGI is less than 100,000, it's 0. If it's from 100,000 to 400, and don't quote me, I could be off a little. It could be 150. If it's from 150 to 400, your AGI, the rate is 15%. And if you're over 400,000, it could go to 20%. But that's another thing Biden's thinking of doing away with. He's going to make capital gains ordinary income. It's one of the things he's thinking of doing away with is capital gains tax. Okay, you guys ready to move to the next one?
Steve, there's a question. Is
Sure.
the tax rate 20%, 21% on the gain, 15% plus 8%?
Well, and that's just federal. Georgia, it would be 6%.
Yes, I'm sorry, 15% plus 6%.
Yeah, plus I didn't. Yeah, that was just for federal. The Georgia's tiered to $100,000 also. So it would be tiered if your AGI was less than 100 grand, and over 100 grand it'd be 6% for Georgia also. But yeah, it would
Thank
be
you.
the federal 15% plus the Georgia 6%.
Thank you.
Sure. Another thing my clients aren't always aware of is they changed the law. I mean, they changed the law a few years ago. Obama changed the law where you're no longer allowed to deduct all your taxes. You're limited up to $10,000 of all taxes, which includes state income tax, real estate taxes, and personal property tax. And that's $10,000 for married filing jointly, and if you're filing separately, it's $5,000. So a lot of people, like my income taxes are way above the 10th. My state property tax, my real estate taxes are way over $10,000. So everything over $10,000, I lost the benefit of. That's something I just wanted to bring to you guys' attention. It's something my clients struggle with and they don't like, but hopefully down the road this will get changed back in time. Any questions on this one? Okay.
Can you repeat what you just said about the 10,000? I'm sorry.
Sure, of course. All right. So on your itemized deductions, you're allowed a deduction for taxes. But the deduction is limited if you're married filing jointly to $10,000. So even if you paid real estate taxes in 20 and you paid 10 in state income tax, which is 30, your deduction would be limited to 10,000 if you're married filing jointly. Did that clarify it?
Yes, thank you.
Oh, of course, sure. All right, the next thing is something my clients don't do a good job of. Keeping track of their home bases. I can't tell you how many people, they go, Steve, can you figure out what my gain on my property is on my home? I go, well, do you have the closing statement? Do you have any backup for all the repairs, all the capital improvements you made over the years? So these are the kind of things you need to tell your clients to save. So I'll go through them with you. The most important thing is when you close on your home, you want to keep a copy of your closing statement in a safe place. Make sure you save it to your hard drive and then save it on a floppy drive, on a little jump drive somewhere, or save it into the cloud. So you have you have a copy of it. So when you sell your house down the road, people live in their houses 20 years. We know what you paid for it originally, and we see the closing statement that backs it up and proves it for the IRS. And just some other things that you can add to the base of your house over the years when you're living there. Like, for example, I put a new roof on my house and it cost, $30,000. That goes into the basis of what you can put in. I had to put in 3 air conditioning units over the last 3 or 4 years. I updated my bathroom and my kitchen. All those expenses can be added to the basis. But make sure you keep the receipts. You want to have all the bills from all the vendors, or if you use one contractor, you want to keep those receipts in the safe place. So if you do get audited, you'll have them. I put in a new garage recently. That you can add to the basis. I added a home theater. Any landscaping that you do that improves the value. Not like mowing the lawn wouldn't improve the value, but anything you would put in, like if you put in a bunch of trees, that would add value to the property. So basically anything that adds value to your property, you can add into the basis. Anything that goes to maintaining the property, you can't do. You can't add to the basis.
This to your personal property?
Excuse me?
Is this to your personal property?
Yes, this is it. We'll get into investment properties later, but yeah, when this is your primary residence, correct?
Wow.
Now the one rule, though, I think I have it on the next slide. No, okay. So the one rule I need to mention here: you can only add $500,000 of fix-ups to your basis if you're married filing jointly, and it's $250,000 if you're filing separately. So you can add up. So if you buy a home for $500,000, you can add $500,000, get your total basis to $1 million. I'm on a screw call. That's okay.
I thought at one time they had stopped us from doing that. There was one time that you couldn't take these type of deductions on your personal property. This may have been a couple of years back. Is this
not taking a deduction? You're adding it to your basis when you calculate your capital gain.
Okay,
So I'm not clear on your question.
When you say adding it to your basis, I don't understand what you're saying.
I'm sorry, can you repeat that?
When you say adding it to your basis, I'm not quite understanding what you're saying. I guess I'm thinking in terms of if I added a new roof and I'm doing my taxes, I'm going to tell my accountant that I added a new roof to my property, and I'm thinking that would be a deductible item.
No.
No. Tell me what.
When you sell your primary residence, you have to figure out how to calculate your basis. And your basis is what you pay for the property plus anything that you spent, which improves the value of your property. So that would determine your basis. So if say you sell it for $1 million, but your basis is $750,000, you'd have a $250,000 capital gain. So I'm just explaining to you that some of my clients don't do a good job of the record keeping. But in the current year, you wouldn't be able to deduct it as an expense. No, I agree. You wouldn't be able to deduct it as an expense in the current year. But your basis goes into determining what your capital gain when you sell the property.
Okay. So this is when you sell. This is not if you're still living in the property and trying to take additional deductions for improvements that you've done.
Correct.
Okay. I was a little confused. Okay, thanks.
No, that's why I'm here to clarify for you. So anything any money you spend on your house while you're living in there that adds to the value of the house, you can add to your basis.
When you sell it.
When you sell it, correct. Your basis determines what your capital gain is when you sell it. Correct.
When you sell it, okay.
And your tax advisor can help you if you're not sure on something. He can tell you which adds value versus which is general maintenance.
Okay.
Steve, one other quick question. For our purposes, what does renovations include? Are there any stipulations? What about minor aesthetic changes like new light fixtures?
Well, once again, Doug, it's a gray area. You got to go into, does it add value to the house? So adding a new light fixture, one light fixture, no. If you redid the whole lighting throughout the house, yes. So it's kind of a gray area. You have to use common sense on it. But if I put a new light fixture for $200, no. But if I went and spent $10,000 on new lighting for my house, yes.
So the key is distinguishing between what would be considered maintenance and upkeep, like replacing a light fixture versus doing something to improve the value of the property.
That's the rule of thumb, exactly. What increases the value of the property? That's the differentiating factor. Mhm.
Okay, thank you.
Sure, of course. Are we clear on that one?
Yes,
I'm
thanks.
move on to now we're moving away from your primary residence into investing in investment properties and commercial properties. So now we're kind of changing gears, kind of. We change your thinking hat a little bit here. Now we're taking a new perspective because they're handled two different ways usually, the primary residence versus how you handle investment properties.
Winston, I have a question.
Sure.
So if you decide to upgrade all the fans in your home to have LED lighting,
Yes.
which is energy efficiency,
Yeah.
that would be a write-off, correct? Towards the
That would be well, it's funny you say, I think there's a credit for that.
Right.
There's certain credits out there that, so when you file your taxes, you get a reduction of your tax dollar for dollar based on what you spend, and it's a funky calculation. But in that case, you get to add it to the basis of your house when you sell the house. Plus, in that year, you'll be able to get a tax credit, which you deduct from the taxes owed. So it's a double whammy in a good way.
I need a good accountant.
But yeah, there's energy. There's a bunch of stuff you can do to your house where you get tax credits for it. That's another area that that's kind of the next presentation. I was going to jump into those things because it gets kind of complicated and there's a lot of them out there. So it wasn't really enough time in this to really go through them all. Okay, so now I want to discuss depreciation and how depreciation affects your investment. Basically, it's funny, when I was in college, I was listening to two lawyers talk about depreciation expense, and they were giving these robust definitions of it. And I said to myself, no, it's so simple. Basically, depreciation allows you to deduct the cost of your property over the useful life of the property. That's a simple definition. It's nothing fancy about it. It's just a way that you can recoup your costs that you spend on the property when you have your investment. And there's two different ways to do it with commercial properties. If it's a residential investment property, you do it over 27 and a half years. And then if it's a commercial property, it's over 39 years. So if it's a residential investment property, you get a much quicker return because you depreciate over a shorter life. One other important thing to know is land is not depreciable. So when you buy a property, say you spend $1 million on a property, you have to go in and figure out what is the cost of the land. And the general rule of thumb is about 20%. But if you wanted to really go in and spend the money for an appraisal, go to an appraiser to do it, he'll give you the exact value. But if you don't have an appraisal done, a pretty good rule of thumb is 20% for the land. And then one other thing, people make a lot of mistakes on if they buy a property, like you go buy an office building, the structure itself is over 39 years. But their components, like light fixtures and the boiler and the air conditioning unit, you can strip those things out and create a value for them and depreciate them over a much shorter time. Like equipment's usually 7 years. So that's the one thing you should tell your clients. If they buy a property, you should list out all the assets you buy and then allocate the cost that you paid for it over all the assets that you purchased. This way you can get a lot more, you can accelerate a lot of depreciation over the time. Any questions? Okay, move on to the next one. All right, I love this topic. My clients always ask me about this topic.
Hey, Steve, real quickly, this is Doug. Just on depreciation, what happens with depreciation is that's a reduction in your expenses each year. So you are a deduction in your income. You have rental income, but you offset it with depreciation to keep your taxable income low. But the trade-off is when you go to sell the property, has that reduced your basis?
Yes, correct, it has.
Okay, thank you.
But that's one of the things I'm going to get into on the last slide. So we'll bring
Okay.
that back over that. There's a way to defer the gain, which is called the 1031, and we'll talk about that on the next slide.
Thank you.
Sure. All right. So this is one of the this is one of the topics that always comes up when I do someone's tax return. What's passive income versus non-passive income, passive versus active participation. In order to be active in real estate, and this is what the IRS code says, you have to put in 750 hours per year in the industry, and then you qualify. And there are other things too, but that's the main qualification, is that you have to work 750 hours in the industry, and then you're considered to be an active participant. So there's still advantage, even if you have passive income and losses, there's still some things out there, depending on how much money you make, that you can drive benefit from. So for example, if you do not qualify as an active participant, but you still have rental properties, you can deduct up to $25,000 a year as long as your AGI is less than $100,000. And then it gets weeded out, it gets phased out as your income goes up to 150,000, your AGI gets 150,000. And once your AGI is over 150, you can't deduct any losses, any passive losses in that year. But if you have passive losses from another investment, passive income, you can offset the passive loss with the passive income in the same year. And so, but if you have net passive loss on a property, you don't get to realize that passive loss until you sell the property and it gets added to your basis. So that's kind of how that works. And it's a little confusing, but I don't know, does anyone have any questions on that? It comes up all the time when I do people's tax returns about passive versus active and what can I deduct and what I can't deduct. No questions on that one? Okay. And then the last thing, as I mentioned a little earlier, was 1031 exchanges. Basically, a 1031 exchange allows for the deferment of a capital gain tax. But you can't do it on residential properties. You only can do it on investment and commercial properties. So there's some tricky rules that you have to do when you do a 1031 exchange. And that is, you have to be able to identify one property or many properties. You're allowed to identify more than one property after the close of sale of the property, but you have to do it within 45 calendar days. But you can identify more than one property. And the second rule is that you have to close on the new property within 180 days. One of the things that's really important is that you get an intermediary to help you, because at the first closing, he's got to keep your money in escrow. The sale of the original property has to be in escrow. And it's a complex transaction, and don't get it. You should get your CPA involved early on when you decide to do a 1031 exchange. And then I was thinking, for the future, if you ever want to do this again, we could talk about conservation easements, various real estate credits, and then opportunity zones on the next presentation. So I'll open the floor to any more questions you guys may have, or anything you might want to talk about. All right, Doug, hand it over to you.
I'm trying to think of a few quick questions, Steve, that I get asked often.
Sure.
We've focused primarily on the federal income tax side. We touched briefly on the state of Georgia side.
Sure.
Is there anything unique to Georgia that we should consider? In other words, what we do at the federal level just carries through to Georgia for income tax purposes.
Correct. Georgia has adopted the federal code, but it has some exceptions and has some modifications. Like depreciation is a little different. Georgia depreciation and federal depreciation vary a little bit. But the one main difference is if you invest in a 529 plan for your children's educations, that you get a deduction for Georgia, but you don't get a deduction for federal. And I think it's $5,000 a year, or $4,000 or $5,000 a year per child per year.
Okay.
That's the main difference. There aren't any other real big differences that you'll find. Georgia pretty much mimics the federal code for the most part, except depreciation in the 529B. Also, one other thing Georgia has when you're retired, actually, I think the first $60,000 of retirement income is tax-free for Georgia purposes. So that's another nice advantage of living here. They try to keep people from moving to Florida, so the first $60,000 of your retirement income, you don't have to pay tax on when you live in Georgia.
Well, that's good to know. The first $60,000 of retirement income. Steve, another question that I get often deals with the state of Georgia has a withholding, it's not a tax, for sales by non-residents of Georgia. As a closing attorney, at each closing, I have to determine if the seller is a Georgia resident. If they're not a Georgia resident, I have to withhold either 3% of the sales price, or if they fill in a short 4-line worksheet to determine their gain, I withhold 3% of the gain. So just something I want to make sure that agents are aware of, that at each and every sale closing, we have to determine the seller's residency and withhold 3% of the gain or 3% of the sales price for non-resident sales.
California is a lot worse, Doug. They do 10%. New York too.
I've got a question. How does the tax law apply when an agent gives a rebate to the buyer or seller, the do's and don'ts to stay out of trouble? And I assume for this purpose, we're talking about the agent rebating a portion of their commission, say to the buyer, towards closing costs.
That's a good question. I had a mortgage company for 9 years, so I'm not as in tune with that, Doug, as I used to be. But I think they can, any closing costs, if they reduce their commissions for it, as long as it's a closing cost on a closing statement, that's fine, and it reduces their commission. The way I would do it is I would have the closing attorney reduce their commission and then reduce the closing cost.
Steve, as a closing attorney, the advice I give, first, an agent under Georgia license law with Greg, an agent may rebate all or a portion of their commission, but it must be disclosed on the closing statement. So that's the first requirement. You can't do this outside of closing, but provided it's disclosed on the closing statement, it's going to be a reduction in income. If agent had a $3,000 commission, rebated $1,000 towards $1,000 towards buyer closing costs, the agent will report $2,000 of income on that transaction. Would that be correct?
Yep. You got to make sure that the closing attorney does it correctly too, because a lot of times they'll issue the 1099 on gross, and that's not correct in that case. It should be on net.
Next question was, can a rebate from an agent commission go towards the buyer's down payment? And I'll tell you that not so much of a tax question, but more of a lending question.
Nope.
The answer is yes, to the extent that the buyer's lender allows it.
Oh yeah. They have to allow it, Doug. I've never gotten a lender. Not when I was doing loans, the lenders wouldn't allow it.
Yeah, so a lot of lenders have what we call a minimum borrower investment. For example, maybe if it's on an FHA and it's 3% down, the borrower must put the 3% from their own funds. It can't, they can't use the money from the agent towards. So I think the best answer to that question is check with your buyer's lender on the specifics.
Yep.
You're allowed to
Yeah,
do they,
in my experience, I never found they'd allow it. And even getting a gift, if you get a gift from your parents to close on a house, it creates so much extra documentation you wouldn't believe. It makes it so challenging. The underwriters scrutinize that so carefully. It's crazy.
my answer is it can be done subject to lender's requirements. And the biggest part of the lender's requirements are whatever the buyer's minimum personal investment in the property is. They have some minimum amount that the buyer must put into the deal, and that's usually the limiting factor.
Is that a Fannie Mae guideline too?
It's it's not just FHA, but this is gonna really it's more lender underwriting than necessarily Fannie, Freddie, or FHA.
They're going to highly scrutinize it, Doug, just so you know. So be ready to
Sure.
give them tons of documentation. It's kind of a headache. The key is to make sure your clients have enough in cash 3 months before, because they're not going to go more than 3 months before. So make sure they have their cash in place 3 months before the closing, because that's what they scrutinize is all their cash activity the 3 months leading up to the closing. So just make sure they have enough cash in the bank to close 3 months prior to closing.
Okay. Steve, before we wrap up, are there any other questions?
Yes, I have one.
Yes, ma'am.
On a personal note, because I do have, rental properties, and I do also, like you, give out advice when clients and close friends and family ask. But is there any place that one could go to find, and this is a tricky one, a list of what are deductibles for their properties, be it a personal or a rental? In other words, does the IRS have like a binder, a publication, or anything that for the everyday person like ourselves that don't know a lot about the tax, are not in a tax environment, could have a checklist of any sort?
Yes, the IRS creates publications.
Right.
But for personal, I'll summarize it for you. You're gonna, on a personal, when it's your primary, secondary, you can deduct your interest and your real estate taxes.
Yeah, like I've been doing. Okay, so
Those are the only two things on a personal level.
okay, and then on the
Now on an investment level, there's a publication out. I don't know the number off the top of my head, but you can go to the IRS website. It's really helpful, and it has all their publications. You just search for investment property or real estate investing property. You can do a search on their website, and they'll come up with the publication for you. But basically, anything business related is deductible. So, like if you have to drive to see your property once a month, the round trip mileage times the reimbursable rate, you can deduct on your tax return. But if you buy cleaning supplies to clean the property, you can deduct that. So anything that has a business purpose is deductible for your rental property. Does that clarify things for you?
Oh yeah, that part I knew. I guess I was searching for. I didn't know if you had an exact publication number, but you said just go to irs.gov.
Yeah. Give Doug your email. I can email you tomorrow.
Okay, I will.
Doug,
that's really good. That's really good to know. I'm going to put in the chat, Doug.
We should have everyone's email address from the registration. And one thing that we do is we record these classes and we're going to upload them to our YouTube channel. So we're going to email to all the class participants the link. If you needed to go back and review the class, you can. We'll email a copy of the presentation and the IRS links that Steve provides us. So we are going to send a follow-up email to everybody with the copy of the link to the recording, the presentation, and a copy of the IRS link from Steve.
Yeah, I'll get you the IRS publishes some good stuff. It's out there, and you don't even have to go to the IRS. You go to just Google and search for this stuff, and I find a lot of stuff just searching through Google. Plus my tax library that I have through CCH. But, there's a lot of stuff out there, and a lot of people publish great stuff out there too. Just got to double check it though. Sometimes if it's not from the IRS website, you can't trust it before you vet it. You know what I mean? But there's a lot of good information out there if you look for it.
Well, in conclusion, I'd like to first thank Steve Lazarou with Zeus Business Solutions, Zeus Business Systems, for being our guest host today, for taking us through the tax questions today. Steve, I appreciate you being here today and sharing your wisdom with us. For all the participants, one expression I always use is a line from the old Kenny Rogers song, "The Gambler." I hope that you found an ace that you can keep. Hope you got some good information in our class today. We appreciate you being here, and we hope to see you at the closing table here in the near future. Thanks
you all.
again, and take care. Go out and make it a great day, and the best of luck to you.
Thank you.
Thank you.
Take care. Thank you very much.
Bye now.
Bye-bye.
Doug, we'll get Steve's information, right?
Yes, ma'am. We'll have everyone will receive a follow-up email in about a week. We'll have a link to the class recording, the Zoom link, or excuse me, the YouTube link with the presentation, a copy of the PowerPoint, Steve's contact information, and the website information that he provides us.
Thank you, Doug.
Thank you. Thanks everyone for coming today.
You're welcome. Thank you.
Take care. Have a great day.
Hi, Doug. Are you still there?
Yes, I'm still here for any questions.
Yeah, quick question. And this is Sandra, by the way. Thank you for the class. Do you guys over at Chapter and Dean work with like foreign nationals that are sellers and or buyers?
As a matter of fact, we do. I have some real estate investors who are based in South Africa, and they buy and sell, buy and renovate and sell properties here in Georgia. I've connected them with an international tax accountant who's actually right here in Milton, Georgia, who helps them with the international tax considerations. And we handle the real estate side, the purchase and sale for them.
Okay, is that Richard Rubin that you use?
Yes, it is. How did you know?
Okay. Oh, so I work with him too for my foreign investors as well. So I've known Richard for probably about 7-8 years. I was introduced to him through Adele Emankabadi. I don't know if you know Adele. Adele does a lot of the EB-5 programs, very instrumental in that in Georgia, which is, the visa for you to get residency through immigration by real estate investments. So that's how the connection to Richard was through Adele. But I definitely want to get your information because we like to have a couple of attorney offices that are versed with working with foreign nationals and foreign investors, so that the process is a lot easier to explain to these individuals, and keeping the transaction clean, neat, and everybody knows what they're supposed to do.
The biggest challenge that we run into, of course, with international investors is FIRPTA, the Foreign Investment and Real Property Transactions Act, which stipulates that 15% of the sales proceeds be withheld for the IRS unless we can find a suitable exemption. And one exemption is if the buyer is buying it as a primary residence and the sales price is less than $300,000. Another scheme that some international investors use is they create a U.S. domestic corporation with a U.S. tax ID number to buy and hold the real estate property, so that the seller is then a U.S. entity. The only trick to that is it must be a C corporation, not an S corporation, because you can't have the pass-through transaction to a non-U.S. resident. But Richard Rubin, the tax accountant, can help people with that. Otherwise, we just have to work through if there's an exception to FIRPTA, and if there's not an exception to FIRPTA, then we have to withhold. And we've got the same issue with the state of Georgia with the 3% withholding for sales by non-residents of Georgia.
So I know you had said for Georgia, it's a 3% of sales price, or if they complete that short form, 3% of the capital gains, right?
That's correct. It's by law, it's 3% of the sales price, but the law also stipulates if they complete this 4-line, it's a Georgia Department of Revenue
Right.
form. I believe it's called an ITAFF2 form, but I could have the form number wrong. But basically, what did you pay for it? What are your capital improvements, your expenses of sale, and then compute what is your net gain. So, and if you're using the net gain, typically is much less than using the sales price.
And your expenses of sale can include the closing costs, the commissions that you're paying as a seller, things of that nature, right?
That's correct. It's going to be your seller expenses for the closing are the expenses of sale. So you start with your basis plus your improvements plus your expenses of sale, and then subtract that from your sales price to determine your gain. Versus
the federal on the FRIPTA, which is 15% of the sales price.
That's correct. And there's no worksheet or way to reduce that. It's just 15% of the sales price for the FRPTA.
Okay, but then you're saying that what some of them can also do is take advantage of the having a C Corp filed as a, did you say like a domestic entity? You said something there that I missed.
Sure. Richard Rubin, the international tax accountant, can walk you through it. But if you have a foreign investor, they can set up a U.S. domestic corporation and buy and sell their properties in the name of the U.S. corporation. Now, they still have to pay U.S. taxes at the corporate level on that, but they become exempt from FRPTA because it's the entity is now a U.S. corporation.
Okay. All right. I'll grab your information, Doug, from one of the emails, I guess, and take it from there. Thank you so much.
Sure, Sandra. I hope that's helpful. And
yes,
you'll receive an email from us with all the information from the class and all of our contact information.
Yes.
Thank you so much.
That's great. Thank you.
Fantastic. Thank you very much for attending today.
This was very informational.
Great. I'm glad it was helpful.
Yes, and it was done in 1 hour.
You know, we try everyone's time is valuable. We do try to keep these sessions to an hour.
I understand, but like, you know, we poor agents have to keep those credits CEUs going too, you know?
Yes, this one is just like a lunch and learn. This one doesn't offer CE credit, but it does. They're intended to be some good knowledge for an hour each month on topics of interest to real estate agents.
It was very good. I really appreciate it. So we will send the information that he was showing on the slides.
That's correct. It takes about a week, and the reason for the delay is we take the Zoom recording and we trim the ends, add the music and the title slide. We make it a video and put it on our YouTube channel so that if you wanted to rewatch it, you could. Cool. And then we send out an email with a link to the video of the class, the presentation, information about the presenter and about our firm.
Oh, fantastic. Very knowledgeable. Make sure your information is in there. Thank you.
Thanks so much. And I appreciate you being here today.
All right. Have a good day.
Thank you. You as well.
Okay.
A special shout out to Dagmar and Gary. Nice to see you guys, even if it's virtual.
Same here. Thank you again for this. I got here a little bit late, but I'm going to watch for that re-record.
That's great. We'll, like I said, be within the week or so. We'll have a link to the class, and you'll be able to watch the class again if you like.
Awesome. Thanks again.
All right. Well, thank you, everyone. Are there any additional questions? If not, we're going to go ahead and close the presentation for today. And take care and have a great day.